Amanda Gordon.
24 seconds away from the opening bow this morning. Good morning to you all. Equity futures pumping higher, up almost 1% on the S&P. On the Nasdaq 100, up about 0.9% off the back of a job markets report that has got a few people saying the word Goldilocks, although it's winded some people up out there, I know. But off the back of that, yields down at the front end, support on equities for now. Let's the opening bow, switch on the board and check out the bond market. Yields on a 10-year shaping up as follows, down 3 basis points on a 10-year to 322.34. If you check out the front end of the yield curve on a 2-year, we're down 8 or 9 basis points to 341. Bit of dollar weakness out there against the euro through much of the session. Euro dollar positive 0.6%, just above parity. Going into next week, the ECB on deck. They're still looking at 75 and potentially tightening into a recession. That gives you an idea of the kind of backdrop we're discussing right now and why so many people will just say that labour market report changes nothing. Bigger things are happening here worldwide and not just here in the United States. Yields down then, 8 basis points, equities up, crude positive. Let's get you some movers. Here's Abby.
John, well, on that story of yields down on that sweet spot payrolls report, we do, of course, have big tech rallying because those shares look less expensive when yields come in. In addition, Microsoft is being helped out well off of its highs, up now right about 0.2%. That dollar in, though, as you were mentioning, of course, they pre-announced weeks ago on FX effect, but right now moderating those gains. Broadcom, on the other hand, up 4.2%, not only helped by yields in, but of course they put up a strong quarter, a solid outlook, booking strong, so a bit of a reprieve for the chip sector. Interestingly, even though yields are in, we do have the banks higher. JP Morgan up 0.9%. This has to do with the yield curve, of course, steepening, less inverted, so again, some strength for the banks. And then one of the top sectors on the day, as you know, John, energy, ExxonMobil participating up 2%, in line with oil's gain. And again, energy is right now the second best sector on the day.
Abby, thank you. Everybody weighing in on this one, including 22V's Dennis Duboucher. He says the following: this is a positive for risk assets on the day as it reduces the odds the Fed has to push rate hike expectations even higher. That being said, demand appears too strong still for the Fed. That limits the upside on this number. Taylor Riggs has more. Hey, Taylor.
Hey, John, and like you said, sort of the risk on asset that you see on an intraday basis, that, of course, really being confirmed in the note that you read. You have equities higher, yields are falling, dollars weaker. So maybe that's sort of an interesting change of a market, maybe not believing a lot of that hawkish rhetoric. I think what is so interesting, if we take a step back and think about where we were around June 14, we've gotten those 275, so that gives us 150 basis points. You have a 2-year yield, though, John. You're only up 7 basis points. Spreads are up a little bit, but only 17 basis points, and an equity market that's rebounding. So is this sort of the delayed effect of a Federal Reserve where we're not quite seeing the tightening yet? Will we not get that till Q4? Is this the Fed that has to go more because the market isn't giving the kind of reaction that typically we'd like to see? That's certainly something that we're going to be diving into and digesting in the closing bell too.
And there's the promo for this afternoon. That's the fee for Taylor Riggs. Taylor, we appreciate it. Looking forward to the close a little bit later. As you all get ready for your long weekend, we caught up with BlackRock's Jeff Rosenberg. Truly, he was wearing shorts and he was ready to go to the beach after the payrolls report. This is what Jeff had to say before he headed to the exit. Take a listen.
What does the report signal about any kind of inflation look through? And I think the labor force participation rate number is really the key takeaway that is the most interesting piece. That's the one takeaway I would have from this report that I think is important is the look through to inflation.
Pleased to say that with us now is Mike Gapen of Bank of America. Mike, great to have you with us, sir. Let's start straight off the top with the jobs report from now 60 minutes ago. Your thoughts on it?
So I agree with Jeff. First of all, I'm not in shorts. You can see I'm in the office. I agree. The key statistic here is that labor force participation rate number. What I think it does is it opens the door for the Fed to slow the pace of rate hikes beginning in September. And then I think you have to balance that with there's enough overall momentum in the economy to say this may not change where the Fed ends up, but it probably reduces the risk of another large rate hike in September. So I think the combination of that bounce in participation, softer average hourly earnings, as well as a tick lower in hours, it signals that some of the tightness in the labor market may be ebbing.
Mike, what's more important here, though? What they do in September, or the fact they've communicated that once they do start to pause, they're going to be holding for a long, long time?
No, the latter, and it's clearly, again, I don't think this report changes where they want to end up or where they anticipate ending up, but it does, I think, mean we can get there in a path of rate hikes that are more a combination of 25s and 50s than, say, 75s or even risking a larger 100 basis point hike. So that's really all that I'm suggesting here, is that it opens the door to a slower pace of hikes. So the key statistic in my mind is the labor force itself. The size of the labor force for the first time has now risen above pre-pandemic levels. That has to give them at least a little comfort and suggest that maybe the labor market isn't quite as off balance as they thought.
What does it mean for your hard landing call?
Look, I'm still of the view that at the end of this, you're likely to get something that's more of a hard landing than a soft landing. Soft landings are hard to achieve. History says Fed tightening typically comes with some slowdown. And it's just my view that the unemployment rate needs to rise more than just a few tenths in order to help bring overall inflation lower. So I'm still in the mild recession camp, despite that this is a report that kind of goes against that view, at least in the short run. So my overall outlook hasn't changed. It's just, I think it reduces the odds of a large rate hike in September, which provides some comfort on the margin.
Mike, what's the character of that hard landing? What is the character of it? We've got unemployment right now at 3.7%. Off the back of that higher than expected participation rate. And the Fed has got unemployment at 3.7% year end, and at 3.9% year end 2023, and at 4.1% in 2024. Do you think they're too optimistic?
Yes, I do. So I would say the character is more like at least a percentage point and a half rise in the unemployment rate. So that would qualify as some pain and some softening in labor market conditions, to use Chair Powell's term. But by historical standards, that would be an unemployment rate that's still around 5%, maybe a little below, which is low by historical standards, and why I would call it a mild recession in that case. So yes, is it possible to get a soft landing? Sure. And the quickest way to a soft landing would be a big, large rebound in labor supply, what this report suggested. But will it continue? I suspect the Fed has more work to do and needs to moderate overall demand, and that's going to involve more pain in labor markets.
And they clearly think that too. Final word, Mike. September 13th, CPI. What are you and the team looking for?
Kind of a repeat of last month, where energy prices provide a break at the headline, and some indication that these big durable goods prices like used cars are indeed softening. So some of the incoming data there suggests we should get help both in some reversal in prices of large durable items like used cars, new cars, household furnishings, and then gasoline prices giving us some relief at the headline.
Mike Apen of Bank of America. Mike, great to catch up. Thanks for being with us, sir. Enjoy the long weekend stateside. Victoria and Jim back with us for a final thought. Jim, you and I have gone back and forth over the last few months, and you know the theme I want to pick up on, the new consensus. Last year it was transitory. This year, you've heard it a million times, we all have. It's short and shallow. We'll get a recession, but short and shallow. Are you pushing back against that?
Yeah, I think so. I'm going to agree with Michael that the history shows that the Fed, a soft landing is what we call it before it becomes a harder landing. For the Fed to bring this plane in a soft landing would be extraordinary, especially given the volatility that we've seen in inflation. All the signs would point towards something to be a little bit more difficult than we're all hoping. Today's employment report was a good step towards a soft landing, but it's only just one report.
Victoria, your take on the same thing?
Yeah, I don't think we're going to see a recession this year. I think we get a soft landing. But when we look into next year, look, we are not in a bubble in this global economy. We've got less than a third of global PMIs in expansion territory. So I think at some point that is going to feed through along with higher rates and hit our economy. We're looking more towards the middle of next year for the pain to really hit.
That's the tough point, and I'm pleased you brought it up. It's got to be Europe. It's got to be China for that matter as well, Victoria. Saw another city shut down yesterday in Chengdu. It was Chengdu of about, 21 million residents, Victoria, in China. The difficulties out there in the global economy, when do you expect to see that show up in the earnings of some of these big multinationals? And I'll go a step further. Given the tightening of financial conditions here in the United States, we need to think about the tightening of global financial conditions. With the inflation backdrop in Europe, That's not at a peak. A lot of people think that's still in their future, not in their past. What does all that mean for how things look here in America? What's the spillover effect look like?
Yeah, I think you're looking into next year, and you've got to think when you look at the energy concerns that are in Europe. I mean, Europe is about 24% of our exports. They're not going to be able to have high demand there. And you look at China and they're exporting. They're not going to be able to do that either with a lot of their factory shutdowns that they're seeing. So as global demand declines over the next 9 to 12 months, obviously that's going to have to flow through to us, and that's where we see more of the concern. Not this year. We will have a small growth recession. That's okay. The economy's strong enough to handle it. But you let higher rates feed through for another 9 months. You let the rest of the economy do that. You see spreads start to widen on corporate credit here because of earnings, and then overseas. That's where you're going to have the pain come in, and I think you're looking middle of next year for that.
Victoria, great to catch up. Thanks for being with us. Victoria Fernandez here with us in New York. To Jim Bianco, thank you to you as well, sir. After the jobs report from about an hour and 10 minutes ago, looking ahead to the long weekend. Enjoy the long weekend. Coming up, the payrolls report, giving the Fed just enough fuel.
It was a good number. I mean, it gives the markets a chance to take a little bit of a sigh of relief.
We'll get the reaction from the White House with the Labour Secretary Marty Walsh in just a moment after the President said more great news on Twitter just moments ago. From New York, this is Bloomberg. Live from New York City, I'm Jonathan Ferro for our audience worldwide. This is the open with equities looking like this. We're positive 0.4% on the S&P 500, on the Nasdaq 100 up a little more than 0.1%, close to 0.2% higher. From New York City for our audience worldwide on TV and radio, I'm Jonathan Ferro. We're joined now by US Labour Secretary Marty Walsh. Secretary Walsh, great to catch up with you, sir. Does this make your job a little bit easier going into the long weekend?
It certainly does. Going to Labor Day weekend, having 315,000 jobs add the economy and the labor participation force number going up as well. So that's a good way to enter the Labor Day weekend.
Been planning to ask you this question since I went to Jackson Hole and caught up with Fed officials last week. I'd love your reaction to this. Do you think higher unemployment is a price worth paying to get inflation lower?
Say that again. Sorry, say it one more time.
Do you think higher unemployment is a price worth paying to get inflation lower?
No, I don't think so, and I don't think that will be the case here. I think that, and again, I don't want to contradict what the folks in the Fed are saying, but when you look at the job openings in America right now, I think we're going to be consistently strong as we move forward here. I think we're going to continue to people be going back to work, having the unemployment, having the labor participation rate getting bigger. I think that's important. I think what's going to reduce the inflation is obviously the Inflation Reduction Act will help us on that. The gas prices continue to come down will help us on that, and then, you know, I think the biggest unknown is going to be what's happening with Russia and Ukraine.
This is what Chairman Powell said last week. He said higher interest rates, slower growth and a softer labour market condition will bring down inflation. They will also bring some pain to households and businesses. He said this: a failure to restore price stability would mean far greater pain. You say you disagree with that, Secretary Walsh?
No, you know, I think that the chairman certainly has a lot more knowledge on this than I do. But my concern is what I don't want to see is people being laid off. I want to see continuously people go back to work, people being able to earn good wages. I think that, you know, overall, and again, we're in a very interesting time when it comes to our economy. Nothing that's been predicted or no indicators that we've talked about in the last 2 years is like any other time in the history of our country. So I think that, you know, as we think about inflation coming down, there's lots of reasons for why inflation went up, and it's not the same old pressures of the past.
Well, this is what Senator Warren had to say to CNN over the weekend in response to some of this. She said, you know what's worse than high prices and a strong economy? It's high prices and millions of people out of work. I'm very worried that the Fed is going to tip the economy into recession. Do you worry about the same thing?
No, I think the Fed's going to be very careful on what they're doing. I think they're taking a very consistent, unique approach to what's happening here. And I think that, you know, again, as we're already seeing some of the inflationary pressures not come down enough, but we're starting to see those numbers go down in the right direction. Clearly, we have a ways to go before we get to where we want to be in our economy when it comes to inflation and prices. But again, all of this was caused for different reasons. And I think that, you know, we just need to continue to work on supply chain. We need to continue to get goods and services into our country. And long term, we need to produce more here in the United States of America. Just
for Americans looking down to D.C. at the moment, Secretary Walsh, I think they're hearing the chairman of the Fed say one thing, and they're hearing another thing from the White House. The chairman of the Fed is preparing the American people for pain that we have to go through to get inflation lower. And I know other people out there think we can get a soft landing, but I'm not hearing that same concern about the future from you, sir. Secretary Walsh, why are you a little bit more optimistic than, say, this Federal Reserve?
Because we have a strong economy, and the president has laid down some really good foundation here for the future of what we're doing here in America. The infrastructure bill, I mean, I take a different approach to this as a former mayor of the city. I think about how do I grow my city. It's by investing in infrastructure. It's about creating more housing. The housing obviously is a little slow right now in the United States being built, but I think there's different reasons for that. And companies are still looking for people. We have, you know, we had a meeting a couple weeks ago at the White House that people were looking at for 700,000 people working in cybersecurity. We have an ability to hire more nurses. We need more teachers. We have lots of jobs in our country that we need for the future of our country to stay open. So I think that when we think about bringing down inflationary pressures, I think it's going to look very different than it has in the past.
I think a lot of people hope that you're right and some other people are wrong on that front. Secretary Walsh, thank you, sir. As always, we appreciate your time, especially ahead of a long weekend. Thank you very much. Going into the Labor Day weekend, Secretary Walsh there from the White House. Mike McKee back with us to break some of this down. Mike, obviously anyone with the White House at the moment, the administration, has got to tread carefully here, but we're getting different messages, aren't we? from different branches of the government?
Well, I think the Fed is trying to get people to accept the idea that things won't be perfect all the time, that we could see a recession or we could see a lot of people out of work. But so far, the numbers coming up good, both for the Fed and for the administration, because while we had unemployment tick up, it was because more people are coming in to the labor force, and that's kind of the way you want to see it develop. It was also broad-based. You look at manufacturing up 22,000. There's now 12,852,000 people on manufacturing payrolls. That's the most since 2008. Construction was up, even though housing has been struggling. So that was a bit of a surprise. Services are always good. The only people who are losing jobs at any significant number in this report were mortgage brokers, because the housing industry. So overall, good news. And it's overall good news that the participation rate rose, because it just shows that people are thinking they can get jobs. And with all those jobs open, as Secretary Walsh said in the JOLTS survey, this is exactly the kind of scenario that Jay Powell said was possible.
Makes his job easier going into the long weekend seems to be the takeaway here, Mike. The takeaway for all the guests on the program after that payrolls report just seems to be whatever they thought before the jobs print, they still think for the Federal Reserve for September. Is that your takeaway as well, Mike?
Yeah, I don't think this is dispositive in any way, because we do have the CPI report coming up. This doesn't prevent you from going 75. This is a good report. It still shows strength in the labor market. But if we see a lot of inflation, then it locks in the 75. If inflation drops significantly, then we could see 50. My guess, they go 75 because they want to get up to that neutral rate and a little bit above as soon as possible, and then kind of sit there and see what happens.
Mike, keep going back to this. Did you ever think we'd be looking ahead to a week with the ECB and a 75 basis point move from the European Central Bank?
No, that is a real shock. But everything coming out of this pandemic has been just crazy. There's no models, there's no past history that matches up. So it's going to be very interesting to see what the ECB does.
The ECB saying they're willing to tolerate a recession. The Federal Reserve is just steadfast on getting inflation down, even if it means higher unemployment. Mike McKee, thank you, sir, as always. I want to get you some sector price action as well off the back of this move in the equity market, which so far has been pretty decent, up about 0.6% on the S&P 500. The last time I looked, up about 0.7% right now. The Nasdaq up about 0.5%. Abby, what have you got?
Well, John, you're right. It is a pretty decent move off the back of this payrolls report. And right now we have all 11 S&P 500 sectors rallying. So this really tells you that it's a broad-based rally as well, a broad-based move up in a difficult stretch, because of course on the week we are lower. Now the top sector on the day, energy up 1.8%. This is oil rebounds. We also have the financials higher, which is really interesting given the fact that yields are lower, especially that short end. But because of that, you of course have the yield curve steepening, which means that they're less inverted. That could help out the banks, materials, tech. So strong participation here from all the different sectors trading higher. On the week, though, I just mentioned we're looking at a down week, a pretty big down week too, down 1.7%, the third down week for the S&P 500 in a row, the longest losing streak before the bear market rally started. So relative to some of the bigger laggards, of course, chips, we were talking about that yesterday with NVIDIA and some of the other chip makers really struggling, with Broadcom, one exception today, but overall weakness there. The energy index on the week lower. The one sector that is higher, food, which is kind of interesting given that's a hot inflation area, but that's how the chips fall on the week, John.
Abby, thank you. About 22 minutes into the session, that's the equity breakdown. At the front end of the yield curve, yields aggressively lower now by 10 basis points. Through 350 in the last 24 hours. Right now, 340. We'll pick up the theme on the bond market on Bloomberg Real Yield at 1 p.m. Eastern Time. Here's the lineup for you. Robert Tipper, PGIM, SocGen, Sebastian Rajappa, MUFG's George Concalves joining us as well. We'll see you at 1 p.m. Eastern Time for that one. Coming up next on this program, we'll get you the trading diary live from New York. This is Bloomberg.
I still think the Fed's going 75 basis points this meeting. The reason why this number is so important is the conditions for employment are so significant. The economy's in good shape, and when you cut across the numbers, I was looking at it again this morning, it shows an economy that's moderating, but certainly not slowing that much.
Rick Reader of BlackRock just 50 minutes or so ago, off the back of the jobs report, equities firmer, up 0.5%. Will it stick on the NASDAQ, up about 0.4%? The bigger move is in the bond market, the front end of the curve. Just that Fed angst cooling just a little bit for now. I stress for now. Yields back in 10 basis points on a 2-year. Back to sub 340 at 339.76 after going through 350 in the last 24 hours or so. That's the price action. Here's your trading diary. Durable goods and factory orders at the top of the hour. President Biden speaking at 11 a.m. Eastern time. Then looking ahead to next week. Markets closed on Monday for Labor Day. US PMIs on Tuesday. Finally, remarks from Fed Chair Jay Powell on Thursday. And an ECB rate decision, and a big ECB rate decision at that. From New York City, that does it for me. If I don't see you at 1 p.m. for Real Yield, enjoy the long weekend stateside. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Friday, September 2nd. Here are the top market stories that we're following for you at this hour. Labor force strikes back. The labor force participation rate climbs, pushing unemployment rate higher as the U.S. adds a solid 315,000 jobs in August. So is it Goldilocks? You got the solid job number. That keeps the Fed on its hiking path, potentially widening its soft landing runway. Stocks up, the curve will steepens. And we have an all-star lineup for you to get into it. We're going to have the economic view. We're going to have the White House view as well as the equity market view. And it's the crackdown on Russian oil. The G7 plans a price cap for Russian crude. We're going to break it down, how it works, how aggressive Russia's response is going to be. From New York, I'm Alex Steele alongside Tom McKenzie and London Guy Johnson is off today. Welcome to Bloomberg Markets. It honestly feels that this job report was so solid, it was actually a bit boring.
The participation rate creeping up was probably the most interesting part. Wages coming off a little bit. Something of a sweet spot, arguably for the Fed, arguably for the White House as well, Alex.
Yep, and then we have other data dropping as well. Let's get to durable goods. That's the final read for July. That's about down 0.1%, so a little bit lighter than estimated. If you back out transportation, it came in up by about 0.2%. So still solid. The numbers still okay, still solid.
Factory orders for the month of July coming in, this is a contraction of 1%. The survey had been for an expansion of 0.2%, so that's worse than expected, and it compares to 2% that we got in the previous month. So this is July numbers, minus 1% when it comes to factory orders. And then you've got a revision as well, 1.8% from the previous month, so down from 2%, revised down to 1.8%. So a little bit of weakness when it comes to factory orders, at least, Alex.
Yeah, and you are seeing the Nasdaq 100 give up all its gains, now trading pretty much flat. All right, let's get back to those payroll numbers here. U.S. employers added more jobs in August. More people entered the workforce. They rose by better than 315,000 jobs last month. The jobless rate rising to 3.7% as that participation rate also climbed. I want to bring in Michael McKee, Bloomberg International Economics and Policy Correspondent. On a Friday of Labor Day weekend, you want some excitement in the jobs numbers. You want drama. This was just solid.
Well, I think it depends on where you are. All the traders out in the Hamptons probably love this because, there's nothing to trade on. It's good news, so we're back to the beach for our last long weekend. Let me take you back into those numbers, though. As Alex said, 315,000 jobs created. But what the story really was the rise in the participation rate as the labor force went up, 62.4%. That's a big jump from 61.2% the month before, or 62.1%. And so it does show that people are coming back into the labor force. And the gains were broad-based in terms of the 315,000, 22,000 in manufacturing, 16,000 in construction. Services, they're always stronger, but 263,000 is a good number. The only people losing jobs in mortgage services, 2,400. And that chart there is really interesting, Alex, because and Tom, because it shows that women are coming back into the labor force. You look midway through the recovery from the pandemic, and there was a big drop there. Women were supposed to come back. They were staying at home, taking care of the kids when schools were closed and taking care of sick people. They were supposed to come back a year ago in September, and they did not. But now they are finally getting back into the labor force and making a big difference.
Okay, Michael McKee breaking down the jobs numbers for us, that participation rate creeping up, wages coming off a little bit. Thank you. For reaction to the jobs data, we're joined now by Aneta Makowska, Jefferies chief financial economist. Aneta, just your take in terms of these job numbers and how it feeds in to the expectations around the Fed later this month.
So I would agree that this was a sort of a sweet spot type report because we're still seeing solid wage growth, probably too hot for comfort in isolation, but I think that's mitigated by that improvement in the participation rate. I think one of the key questions is, can we continue to see further improvements in participation? I think that's going to be difficult because, although the aggregate participation is still a full percent below the pre-pandemic level, when you look at prime age cohorts, right, we're only 0.2 below. And in fact, within most age buckets in the prime age categories, we're back to pre-pandemic levels of participation. So there's some slack in 20 to 25-year-old cohort, and there's a lot of slack in that sort of 60 plus. And so I think it's going to be much harder to sort of repeat this type of increase in participation going forward. So, I think it was good for today. I think it's a status quo report in terms of its implications for the September meeting. We're still leaning toward 50, but we do think that this screams for, the labor market in general just screams for a much higher terminal rate. We just don't necessarily think that it has to get there fast.
Aneta, let's go to that labor force participation rate point you were making. If we can't do a repeat of this, then what's going to have to happen? Does that imply stronger, faster rate hikes from the Fed to get that unemployment rate up, and that really takes away that soft landing scenario?
Yeah, I think it increases the odds of the uptick that we saw in the unemployment rate is a little bit of a one-off, and that it actually starts moving down again, because we know labor demand continues to be strong, and if we see these types of job gains going forward with smaller improvements in participation, unemployment's just going to go right back down. And that just means tighter for longer labor market, and ultimately the Fed having to do to be more aggressive in order to dampen labor demand. So I think that's the direction we're headed in. Again, the question is, does the Fed have to get to that 4% terminal rate tomorrow, or do they have a little more wiggle room? And I do think today's report maybe extends the runway a little bit.
Okay, extends the runway a little bit. When it comes to wage growth, I know you touched on this. We saw wages growing again, but below some of the estimates. Does that trend continue, the slightly slowing, the slightly cooling wage growth that we've seen?
Yeah, I think it's too early to tell, to be honest. I think what you saw in July with that, outsized increase in wages was a lot of companies implementing mid-year wage increases, and then you just didn't see that in August. So, when you average the last 2 months, we're still growing at a pretty solid pace. We're still at 5.2% on the year-over-year basis. And here's how I think about the implications of the labor market for inflation. If we stay at this 5.2% wage growth, even if we assume that productivity returns to its longer run trend of 1.5%, that still leaves employers with about 4 percentage points of wage inflation that is not offset by efficiency gains. And in my mind, that sets the floor for inflation around 4%. So yes, we're sort of shedding some of the impact of higher commodity prices, supply chain pressures. Those are falling out of the inflation calculations, but I think at the end of the day, we're still going to be left with roughly 4 percentage points of core inflation that's just coming from the labor market.
Well, and then that leads you to your 4% or plus terminal rate then for the Fed. I'm wondering what kind of recession you think that's going to bring at this point.
So I think it's not necessarily deep, but it's protracted. So we're modeling a recession starting in the third quarter of next year. So we certainly don't think it's imminent. We actually think it's going to be quite hard to put this economy into a recession. So we think that starts in the third quarter of next year. And it maybe starts out kind of as a fairly shallow recession, but we also don't expect the Fed to come to the rescue right away. We don't have cuts in our base case until early 24, and it typically takes about 2 to 3 quarters for the economy to inflect out after the onset of an easing cycle. And again, we think that's going to be delayed. So we're modeling a roughly 5-quarter recession. So again, not necessarily deep, but protracted. And I think ultimately the Fed's going to have to push the unemployment rate to 6 to 7% range to get us back to that 3.5% wage inflation that then allows inflation to fall to 2%.
And then I love getting your perspective. And as we're looking at it, one full cut from the Fed isn't now priced till September 2023, but still doesn't match your base case. Annetta, great to get your perspective. Annetta Markowska, Jefferies Chief Financial Economist. Thank you so very much. All right, coming up, more reaction to those jobs August numbers. NASDAQ 100 now right around session lows, just up by about 0.1%. Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs, will weigh in. This is Bloomberg.
Monday, the UK Conservative Party decides who will succeed Boris Johnson as Prime Minister. As Rishi Sunak and Liz Truss go head-to-head, keep it tuned to Bloomberg for the latest news and up-to-the-minute results. Bloomberg, your global business authority.
We all are focused on the economy, and we want to know whether or not there's going to be a soft landing or not. But the Fed is focused on inflation. The economy could just sit there and it can do what it wants. Look, we had 2 negative GDP reports in the first half of this year. Didn't stop them from raising rates 200 basis points. So I think really what we've got to do is we've got to pivot away from the economy, focus on the inflation story. And the Fed is committed to raising rates till we get to 2%. That's not happening for a long time. So I think when you do it when you look at it in those framework, it makes sense that they would hike 75 and they would stay very aggressive. And I think that's what the market's trying to sort out right now.
That was Jim Bianco of Bianco Research speaking earlier on Bloomberg Television. As U.S. employers added about 315,000 jobs, it is healthy and moderate. But what does it wind up meaning then for the equity market? NASDAQ 100 now up by 0.5%. Peter Oppenheimer, Goldman Sachs Chief Global Equity Strategist, joins us now. Peter, your take on the jobs number, your trade on it.
Well, I think overall it was a pleasing number. It may go some way to alleviate some of the concerns that have been building up since Jackson Hole. But overall, it does still, I think, suggest that we're in a period where rates have got to go higher for some time to really alleviate some of these inflationary pressures on a more sustained basis. And during the rally that we enjoyed during the summer, the market really didn't believe that. And I think we're in the process of an adjustment to reflect that reality now.
Peter, where are we in that adjustment? The higher for longer, that sustained lower growth trajectory that Jay Powell outlined, where are we in the market adjustment to that? And with the June lows, do they mark the bottom at this point?
Well, I think when you consider the prospects for inflation being higher for longer, not anything like we saw in the 1970s, and certainly some of the pressures are easing, but much higher than we've seen in the last decade, and you look at where interest rates are, and of course some of the obvious downward risks to growth, not just in the US, but particularly in areas like China and Europe, equities haven't really fallen that much. Most major equity markets year to date, and they peaked at the beginning of the year, are down around 15%. And I think they could fall further and valuations could come down more before we get to the sort of point where a more sustained transition into the next cycle is properly priced. We did get towards that sort of level, I think, before the June rally, when we were clearly in bear market territory. But I think the optimism about a Fed pivot, which was probably premature, led to some relief, particularly for some of those long duration stocks, which have fallen in that first phase. So I think we need to get back towards the sort of lows we were seeing before. But it's not just the level, it's also the valuation and the realistic pricing of higher terminal rates and weaker growth.
Yeah, but levels are fun to talk about. So Peter, does that mean that we break 3,600? And how do we do it this time? What does it for us?
Well, I think the combination of continued strength in the labour market in the case of the US, leading to higher inflation expectations would be something that will continue to encourage the Fed and indeed other central banks to be persistent in their message that they're determined to reduce inflationary pressures and raise rates. But of course, in combination with that is the expectation about the extent of any economic slowdown. Now, when we look at how the market is pricing that, of course, there are many ways to do it. Just simply looking at the way that the most cyclical stocks have performed relative to the most defensives does suggest, of course, that the market is pricing a slowdown. That wouldn't be a surprise. But at this stage, it still looks to be pricing something of a soft landing. Now, we do think there are some reasons to be positive, strong private sector balance sheets, and even in those areas the most risk of growth deteriorating like Europe, we're going to see more fiscal support. But I think the market will get to pricing more recession risk before we get a genuine turnaround.
Peter, when it comes to the question of yields, we've come off the 3.5% that we saw yesterday on the 2-year. But as you look ahead to that rate trajectory from the Fed, the implications then of real yields, nominal yields, and the impact, the read across to equities, are we looking at 4% by the end of this year? And if we are at those kind of levels, what is the read across? Which parts of the equity market are most sensitive to that?
Well, certainly the longest duration parts of the market are most sensitive to it. And of course, they were the ones that experienced the most damage in the first phase of the bear market, as rising inflation and interest rates really set the tone. But I think it's not entirely so clear moving forwards, because the axis of market bifurcation that dominated the last decade, growth outperforming value, itself is not such a valuable way of looking at things now. Growth itself is really splintering between unprofitable, very long duration speculative growth, which is very vulnerable to rising rates, and against that more stable, defensive, profitable growth, which looks much more defensive in an environment of rising rates. Simply, the value areas themselves are splitting between the more cyclical value elements of the market that are very at risk of recession, and against that, those areas that are really at the source of inflation, which can pass on higher costs, like commodity-related areas, which we think are actually more defensive as well. So I think overall market levels have probably got to come down, but I think we're going to get quite a curious mix of relative winners, and really margin sustainability will be the key factor.
So Peter, to that point, if markets now are pricing a soft landing, but they need to start pricing a recession, how deep of a recession, what kind of recession do markets need to price? Because that's going to determine how defensive you get, how offensive you get at the trough.
Yeah, here I think I'd be more optimistic. I don't think we're likely to see recessions anything like as deep as we saw, for example, around the financial crisis, where there was a significant deleveraging of private sector balance sheets that led to really a very negative spiral. Here we have some very important underlying supports, strong labour markets, as you've been discussing. We have still pretty healthy private sector balance sheets, which won't prevent a recession, but will moderate a downturn, and also allow margins to be a little bit more stable than they've been in other periods. So I don't think we're going to see a collapse in growth or in profits. I do think earnings revisions have got to come down more in the next phase. But still, to get to a bottom in the market, I think valuations have probably got to be lower, and more recessionary risk at least has to be priced relative to what we've seen. And alongside that, probably higher terminal rates. So I don't think the absolute levels need to fall that much. We think we're in a more fat and flat type of market, lower returns, higher volatility, until there's more clarity and confidence about the prospects for a recovery from the levels from which the market has priced a recession.
Peter, you touched on commodities, and I know Jeff Curry and the team have worked very hard on the call around commodities. They're still very bullish, and it seems like you're aligning with that view. Just to unpack that for us, when you look at what's happening in China, the lockdowns of cities like Chengdu, concerned today around whether or not Shenzhen will be locked down again, and then the almost consensus call that you're going to get a recession in Europe. How do those things come together and provide a bullish case for commodities?
Well, I think there's a balance, as with many things, between tactical and cyclical factors on the one hand and structural ones on the other. And of course, commodities are not an anticipatory asset. They're going to reflect the balance of demand and supply at any time. And as people worry about recessions and you get some demand destruction, there will be some downward pressures. But the key to this argument is more a secular one. And that is that really the underlying problem is one of supply, not of demand. We've had years of underinvestment, and the pricing mechanism is not working as well as in the past. Rising prices are not encouraging higher investment because there's the perceived lack of long-term duration of new investment projects as we move towards energy transition. So we think there's a structural supply problem here, which is going to keep prices elevated for quite a long period of time. And really the answer to this is not weaker demand. Structurally, it's increased investment, and that's why we think prices can stay elevated for some time.
And that's going to, like you said, take a while. Last question here for me, Peter. If the ECB goes 75 next week, what happens to stocks in Europe?
Well, I think increasingly that is being priced. But I think I don't think that's going to be the key determinant of where European markets move in the next couple of weeks. I think much more important will be any evidence of an ability of European economies to intervene successfully in capping higher energy gas prices, which will have a much more important effect really on the consumer, which is where a lot of the concerns are right now. So I think increasingly that is being priced as an interest rate move. It may help to moderate the currency, of course, a little bit as well. But I think the key thing is going to be, in Europe's case, the prospects for growth, demand, and how deep a recession is. And a lot of that will be determined by the impact of higher commodity and energy prices.
Yeah, and we see that cap on Russian gas coming through, or Russian oil, I should say, coming through from the G7. Of course, gas prices have come off today. Peter Oppenheimer on the shape of the recession here in Europe, but also the US as well, prospective at least, or prospective potential. Goldman Sachs Chief Global Equity Strategist, thank you for joining us and for your thoughts as ever. Stay with us. This is Bloomberg.
Economic fallout is.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ruchika Gupta. Bloomberg's learned that Japan's SoftBank is planning to cut at least 20% of the staff at its Vision Fund operation. The world's biggest tech investor will slash a minimum of 100 positions. Earlier this summer, the Vision Fund posted a record $23 billion loss. South Korea sees new U.S. rules that favor American-made electric vehicles and batteries as a betrayal. That's according to a senior government official in Seoul. President Biden's Inflation Reduction Act includes tax credits for those who buy electric vehicles made in North America. That could hurt South Korean brands like Hyundai and Kia. Shares of Broadcom are higher today. The chip maker that supplies some of the biggest companies in the tech industry gave a strong sales forecast. That suggests Broadcom is sidestepping a broader decline in chip demand, at least for now. And that is your latest business flash. Alex?
All right, thanks so much, Ritika. And that's interesting, too, because the semi-index, the stocks, got really killed this week, as much as falling almost 10% at one point. However, some investors were contrarian, Tom. You take a look at this great chart from Dan Curtis. And this shows the 3 times bull chip ETF. It's the SOXL. And you can see the decline that we've seen, but the blue line on the bottom part of the chart shows the equity fund flow. It's been picking back up. The moving average of that has been picking back up. It feels like investors were trying to catch a falling knife there. I don't know how long you stick in with that, but at least in the Broadcom world, that seemed a little bit better than the likes of, like, I don't know, Seagate or NVIDIA.
Or NVIDIA, yeah, indeed. You had all that negative news flow around NVIDIA. It was the geopolitics, but it was also the warning, the cut to the forecast, and then Broadcom, of course, coming out with better results. So we had this debate yesterday whether this is still a cyclical industry or not, and then how you pair, of course, what's happening globally across the economy with that slowdown in that demand for semiconductors. But the flows are really, really interesting, and whether or not this is going to pay off for those investors, Alex.
We're about an hour into the U.S. trading session. On this Jobs Friday, we also got data from factory orders for July, down 1%. You also might be having durable goods orders, the final read for July, down 0.1%. So the data continues to be compiled here. The Nasdaq 100 holding on to those gains now, up by a full percentage point. Bloomberg's Abigail Doolittle is tracking those moves. Abigail?
Yeah, Alex, we are looking at a very solid day here for stocks. A good Friday after lots of down days for the S&P 500. In fact, the index is still down on the week, down for a third week, but on on the day, take a look at this. The S&P 500 up 1%. The NASDAQ up just about as much on that Goldilocks jobs report. Not too much, not too little. And of course, with this, a piece of this picture is the idea that maybe the Fed's not going to have to go full tilt. You see yields in a little bit, that 10-year yield in 5 basis points. Although lots of strategists, including Rick Reeder over at BlackRock earlier, he was telling Jonathan Farrow that he still thinks 75 basis points is what will be the move in September. Crude oil getting a little bit of a bid. So overall risk on picture. Where we're not seeing risk on, in this terminal chart picked out by one of our producers, Pete DeTerrace, I was pretty stunned by this. This is pretty incredible. This is the largest drawdown ever for an aggregate bond index, going all the way back to roughly 2000. So you can see this is a measure of price. You can see down 20.4%. I didn't know that's actually, I guess it's just surprising, I should say. I shouldn't say I didn't know, but it's surprising that bonds could fall that much. Usually the price drop is not so much, and especially kind of overtaking the financial crisis period, but that's the degree of the drawdown that we have had. As for some movers to the upside on the day, we do have earnings in focus. Lululemon up sharply higher. They boosted of 11% nearly. This, of course, is there's brand loyalty, inflation not putting those shoppers on hold for Lululemon athletic wear. Broadcom also a nice quarter of 4.3%. What probably stands out here the most, they also boosted the outlook and booking strong, but chip makers under so much pressure. Alex moments ago was talking about that pressure that stocks have been under. This is one nice reprieve for the chip space. And then going back to another point that Alex was making about strong data overall, this is the Citi U.S. Economic Surprise Index. So we've had this solid jobs report. Of course, that participation rate higher, which is a good thing, many are saying, because it brings up the unemployment rate, so a more natural solution to inflation. But all of these jobs data, Tom and Alex, you can see it's really helping out this Citi Economic Surprise Index.
All right, Abigail, thanks so much. Really appreciate the roundup of the market action today. Well, U.S. employers added more jobs than expected this month. More workers joined the labor force, and that pushed the unemployment rate higher. We got the economic view, we got the market view. Now let's get the White House view. With us is Chairman of the Council of Economic Advisors, Celia Rouse, and she joins us now from Washington, D.C. It's great to get your perspective. I'm very much looking forward to this conversation. Thank you for joining us. That increase in labor force participation rate, we're almost near pre-pandemic levels. How sustainable is that increase?
Well, look, we welcome the report today. It suggested we got solid gains, as you noted, about 315,000 jobs overall. We saw an increase in labor force participation rate, especially among women, especially prime-age women. And that did bring along a slight increase in the unemployment rate, but overall a solid report that suggests that we're making the transition that we know we need to make in our labor market to steady, sustainable economic growth. So we're optimistic that the labor force participation rate can be sustained. We know that we're learning to live alongside the pandemic. Buried in the current population survey data from BLS were questions about the impact of pandemic on people staying home, et cetera. That's been stable over the last couple of months. We know we have the new bivalent vaccines that are available, and we believe that all of that will help sustain labor force, not to mention the fact that our schools are reopening. That is what has helped women's labor force participation in general, and they're going to be open, and there's every confidence that they'll be able to remain open. So we're optimistic because that is the kinds of transition we'd like to see as we move off of this very tight historic growth that we had last year.
Cecilia, what is your level of confidence that wage, that labor-driven inflation is starting to peak now?
I'm optimistic.